Hello and welcome to CN Professional Institute. In this tutorial, we will delve into the world of inventory accounting, exploring the ins and outs of IAS 2 inventory. By the end of this tutorial, you should be able to 1. Explain IAS 2 requirements regarding the valuation of closing inventory. You should also be able to explain and demonstrate how to calculate closing inventory using various valuation methods. You should also be able to explain and demonstrate how opening and closing inventories are recorded. You should be able to explain the impact of using different valuation methods on both profit and asset values. You should also be able to explain or prescribe accounting treatments for inventories, demonstrate the cost to recognize as an asset which will subsequently be expended, and finally be able to provide guidance on cost formulas to adapt and when to write down inventories to your net realizable value. And so these are some of the learning objectives. By the end of this lesson, you should be able to answer these questions. Now let's start. What is the scope of IAS 2? What does IAS 2 cover and what does it not cover? IAS 2 applies to all inventories except 1. Work in progress arising in construction and service contract. That's under IFRS 15. Financial instruments here under IAS 32, IFRS 9, and IFRS 7. So financial instruments are also exempted. And then biological assets related to agricultural activities to the point of what harvest. So IAS 41 is also what excluded from IAS 2. So IAS 2 applies to all inventories except these three. Except these three. 1, work in progress under IFRS 15, revenue from contract with customers. Financial instruments under IAS 32 and IFRS 9. Then finally, biological assets under IAS 41. And so this IAS 2 standard here, the standard we are going to look at applies to all inventories except these items. And then these items, they have their specific treatment. Okay, so we'll look at them in other videos. Let's look at key definitions, some key definitions. Okay, some key definitions. So when we talk of inventory, what do we mean? What are inventories? Right? So we say inventories are assets. They're here. 1, that is held for sale in the ordinary course of business. That's finished goods. They are assets in the process of production for such sale. Work in progress here. And then finally, in the form of materials or supplies to be consumed in the production or rendering of services, raw materials. And so when we talk of inventory, we mean they are assets which come in the form of what? Finished goods, work in progress, and raw material, right? So if you can recall probably your level 100 or your senior high, we learned that inventories are in 3 forms: finished goods, work in progress, and what? Raw materials. That's the same thing we're talking about here, right? So inventories are, or they come in the form of these 3. Okay, now let's take a real estate company. Okay, real estate company. What will be their work in progress? What will be their finished goods? And then what will be their raw materials? Okay, so starting with the raw materials, if you pick a real estate company, their raw materials might be cement, the cement that they use in what producing their iron rods, okay, and other stuff, things that they need for the construction, things that they need for the building. That will be the raw materials. Okay. Then their work in progress will be the uncompleted buildings. Okay. Probably they've started, they've gotten the first floor, they've gotten the second floor, third floor. Some are not cemented, they are not tiled. That is their raw materials. I'm sorry, that's their work in progress. So the uncompleted buildings will be their work in progress. Okay. They are yet to be completed. Okay. So that will be their work in progress. And their finished goods will be the completed buildings ready to be what? Sold. Right. So that's that. So that's the key definition of what? inventory. Inventories are assets that are held for sale in the ordinary course of business as finished goods used in the production process, work in progress, and then raw material. Right? Now, let's look at the initial measurement of inventory. Right? Initial measurement of what? Inventory. When we say initial measurement, what do we mean? What do we mean by initial measurement? Now, initial measurement refers to the process of what? Assigning values, okay, to assets, to liabilities, to equity when they are first recorded in the books, right? So when we talk of initial measurement, we mean at what value, okay, are these inventories first recorded in the books? What value do we first record in the books, right? So that's the initial measurement. And we said all inventories are initially measured at what? Cost. Okay. All inventories are initially measured at what? Cost. So don't forget that. That's something you have to know. Very, very important. All inventories are initially measured at what? Cost. We have it here. What entails cost of an inventory? We know that inventories are initially measured at what? Cost. But when we say cost of an inventory, what goes into the computation of cost and what does not go into the computation of what? Cost, right? So cost of an inventory can be either the purchase cost, the conversion cost, or any other cost required to what? Get it into its what? Current condition or location, right? So we said we have purchase cost, conversion cost, and any other cost required to get it into its what? Current condition and location. Now, inventories are either purchased or they are manufactured. So an entity can decide to what? Buy its inventory and sell, or it can decide to what? Manufacture it itself, right? So an entity that sells let's say that sells bread, okay, can decide to what? Buy the bread and sell, or they can do the bread themselves, get their flour, get their salt, everything, the ingredient, and produce it or manufacture it themselves, right? So we say inventories are either what? Purchased or they are manufactured. If the inventories are purchased, then their cost will be the purchase cost. If they are manufactured, then the cost will be the conventional cost, right? So let's look at where inventory is purchased. We said when inventories are purchased, we measure them at what? The purchase cost. The purchase cost include purchase price, right? Less discounts and what? Rebate. And the discount here is trade discount. Don't forget, we have two discounts in accounting. We have trade discount and we have what? Cash discount. The discount we are talking about here is the trade discount. The discount you receive when you first buy the inventory, that's the trade discount, right? So that's what we are talking about here. If you have cash discount in the question, we don't less it. Okay. So it's the trade discount that we are talking about. Okay. So we said that the purchase cost include the purchase price, less discounts and what? Rebates, right? So what do we mean by discounts and then rebates? Discounts are it refers to just an immediate price reduction, okay, at the point of you buying or at the point of you selling, right? So it is the immediate price reduction at the point of sale, right? Rebates, on the other hand, are similar to discount, but they are not the same. Rebates are partial refund or reimbursement provided to a customer after purchase, okay, for so many or for other reasons. There could be a partial reimbursement or refund provided to a customer after you have paid for the item, and that becomes what? A rebate, right? So discount is given at the point of purchase, whereas rebate is a reduction after the purchase or sale is what? Made. Okay. So don't forget that if the purchase price includes both the discount and the rebates, then we have to what? Less it. Okay. Then we also have import duties. We add it. Irrecoverable taxes or non-refundable taxes, they're also added. Okay. Now, what do we mean by non-refundable taxes? As the name implies, non-refundable. So there are taxes that cannot be recovered after we pay for them. Okay. Or after they've been paid, we cannot get them back. We cannot what? Recover them. Okay. So they are the non-refundable or the irrecoverable what? Taxes, and then we also add them transport and handling costs, like what? Carriage in what? You purchase your inventory, you have to transport it to your what? Your warehouse or to your factory or to the present location, right? So carriage inwards and stuff, they are part of transport and what? Handling, and any other directly what? Attributable cost. we add it to get the purchase cost. Now, we also said an entity can also decide to what manufacture the inventory. Let's see with the same bread example, we said an entity can go and buy the bread and sell, or they can manufacture the bread themselves. If they decide to manufacture the bread themselves, then what goes into the computation? Okay, and we said if the entity decide to manufacture the bread themselves or manufacture the inventory themselves, then the cost of the inventory will be the conversion what cost. Conversion cost includes all direct costs like materials, direct labor, and what direct expenses, right? Plus a percentage or a proportion of fixed and variable what production overheads. So if you could recall, at the senior high or probably your first year in 1100 or your first year at university, we learned something like you might have learned something like manufacturing account, right? For entities that do manufacturing, what goes into their production cost, right? You could see that we have to sum all their direct expenses or the direct cost, then we name it what prime cost, right? Then we add a proportion or a portion of what production what overheads, we add production what overheads, okay, to it, and then we get something we call the production cost. Sometimes the production cost includes adjustment for what work in progress and stuff. So what you have to know is that this is very similar to your manufacturing what account, right? So to get the cost of production or the cost of conversion, we have to bring all our direct expenses together. That's direct labor, material, and another what expenses. Then we add a proportion of or an allocation of what our production what overheads. And then the allocation of the fixed production overhead is based on the normal capacity. It's also something key that you have to know. Normal capacity. Now, why am I laying emphasis on this? It's very, very important. Overheads are allocated or apportioned using the entity's normal what capacity, not their actual, right? So how many units do they normally produce on the normal basis? How many units do they want produce? That's the normal level. We don't use the actual. Something might happen and then they might not be able to produce the normal, right? So in a question, you have to watch out. Okay, we use the normal activity to do the apportionment, okay, of the overheads. And we have other costs here incurred in bringing the inventory to their present location and condition, right? So that's the initial measurement of inventory, or inventories are initially measured at cost. And we said the cost can either be the purchase cost, the conversion cost, or any other cost that is directly attributable or that's required to bring the inventory to its present condition and location. Now, what is the cost of purchase? So we said, as we said, inventories are either manufactured or they are purchased, right? So if an entity decides to purchase the inventory and sell, what will be the cost of purchase? The cost of purchase includes what the purchase price. I've talked about this already. Less discount and what rebate, import duties, right? If you are bringing goods into the country, how much do you pay at the port? Your duties, right? When you are bringing goods into the country, they are also added irrecoverable or non-refundable taxes also explained. I also added transport and handling like carriage in works are added, and other directly attributable costs are also what added, right? So that's how we get the cost of purchase. Very good. Then let's continue with the cost of conversion, right? So we said inventories are either purchased or manufactured. If an entity decides to manufacture the inventory, what goes into the cost of manufacturing? What what goes into manufacturing, right? Now we said to get the cost of conversion, okay, to get the cost of conversion, we have to look at one, we have to add all our directly attributable what costs. So direct cost, okay, which includes direct labor, material, and then direct expenses. We looked at this already. We add them, we get the prime cost, and then we bring what a systematic allocation of what overheads, a systematic allocation of what overheads, and then these overheads include both fixed and what variable overheads, right? Then here we have fixed cost or fixed overhead cost, right? As we know, they are costs that remain constant. Okay, they are costs that remain what constant irrespective of the level of what production. So irrespective of the number of units that we produce, they remain constant. They do not what change. So depreciation is an example, and then probably what administration what cost, right? So don't forget that fixed overhead costs do not change. They do not vary. They remain constant throughout what the period, or they don't change irrespective of the level of what production. And variable costs, they vary. They change as the volume or the level of production also what changes. So when we produce more, we incur more variable costs. We produce less, we incur less variable cost, right? And as I've explained, the allocation of overhead, right? So the cost of conversion is based on normal capacity here. Normal, I've explained that based on normal capacity. So we don't use the actual capacity of the entity, but the normal what capacity, right? So that's the cost of conversion. We add all our direct costs like direct labor, direct material, and direct expenses. We get the prime cost, and then an allocation of what the overheads. We add it, and that becomes the production cost or cost of what conversion, right? Then we have other costs, which we said they are costs incurred in bringing the inventory to their present location and what condition. We've also gone through this, right? So this year, and then an example of such cost is the cost of designing products for specific what customer needs. Good. Now that we know what the cost of an inventory is, let's look at cost to exclude. So we know what to include in the computation of cost. Okay, when we are finding cost of inventory, what do we include? Right. Now let's look at what not to include. That's cost to exclude. Now the first cost to exclude is abnormal wastage. Abnormal wastage, right? Abnormal wastage. So here we have it here, abnormal wastage, right? So it says wasted materials, labor, and then rest. Now, let's say sometimes you bought materials worth 50 million, okay, to be used in your manufacturing, okay, but you realize that, like, let's say 2 million worth of material is what wasted. 2 million is wasted. You don't have to include the 2 million in the cost of what the inventory, even though you purchase the inventory at what 50 million, right? You have to deduct the wasted material. You have to deduct the 2 million from it, and then the 48 million is what you're going to record as your actual cost of what the material, right? Labor to the same thing. You can pay labor for a particular month, and they might not work because of something, because of, let's say, labor shortage. They might not work. Okay, they might be lying, or they might not be doing anything. They might be redundant, or they might be lying idle, right? Let's say as labor is working or as they are producing, they run out of staff, they run out of materials, right? And so they have to maybe halt or hold on for like a 2 month, 3 month. You pay them. Such cost is not such cost is not what added, it's not included, it is deducted. Okay, it is deducted from the cost of what labor, right? So abnormal wastage is not included in the cost of calculating inventory. Storage cost, like your warehouse and stuff, is also not included. Administrative expenses, selling cost is also not included. And then we have here, very important, interest cost is also not included, where settlement is deferred. I'll come back to this and explain, but let's look at the next slide here. Now, it says inventory purchased on deferred settlement terms. That explains this one, this interest here, right? This interest cost here. Let's explain it better in the next slide here, right? So it says inventory purchased on deferred settlement what terms, right? Now it says inventories are purchased when inventories are purchased on deferred settlement terms. Such arrangement contains a financing what element? Key thing, contains a financing what element? Contains a financing element. Now, what do we mean by this? what do we mean by this? When we say this, what do we mean? Right? What do we mean when we say such an arrangement contains what? A financing element. But look at it, you get it. It says that portion of the price that can be attributable to the extended credit terms. The difference between the purchase price for normal credit terms and the amount paid is recognized as interest expense over the financing period. We take it as interest expense and record it in our P&L. We don't add it to the cost of the inventory. Now look at something. Let's say the cost of your inventory is 70 million. Okay. If you go to the shop today and you want to buy it, it's 70 million. But you don't have money, so you want to buy it or you want to pay for it in 8 years' time, or let's say 4 years' time, or probably 2 years' time. Right? So the normal cost of the inventory is 70 million. But you want to pay not now, but in the future, like 2 years' time. Right? Now your the seller might say, okay, if you want to pay for it in 8 years' time, then you will not pay 70 million, but you pay what, 80 million. Right? Now, how much do you record in your books as the cost of the inventory? Is it the 70 million or the 80 million? Right? The standard is you have to record the 70 million. That is the price for the normal that's the price for the normal term. Like, so if you should buy it not on credit, how much will you pay? Are you following? How much will you pay? That is the price for the normal purchase, right? So we will record the 70 million in the books. Then the difference between the 70 and the 80, which is the 10 million here, is what we call the interest expense. The interest expense, which will be what? Expensed, okay, over the period of what? Finances, over the 2-year period. That's if you pay in 2 years' time, then you have to record the 10 million over the what? The 2-year period. Okay, so it's saying if this happened, then this is how we do what? We treat it, right? Now, let's look at the second part, which is IAS 23 here. It says IAS 23 will apply for qualifying assets. Here, qualifying assets. And then the borrowing cost may be included if the criteria are met in accordance with IAS 23, right? So what it means is that if the inventory that you are producing is a qualifying asset, then interest on such inventory will be accounted for using IAS 23, right? So if it takes a substantial period of time to make the inventory available, then IAS 23 is saying we should capitalize such expense or such an amount in accordance with IAS 23, right? Other than that, such interest will be what? Expensed, right? So if you purchase inventory or you manufacture a particular inventory and that inventory is a qualifying asset, it takes a substantial period to make it ready. Then we apply IAS 23 and the interest on it will not be expensed, but we'll account for it in accordance with IAS 23, right? So that's what has been explained here, up here, the interest expense. So with inventory, we normally expense the interest expense. We don't capitalize it. They are normally expensed because most inventories are available for immediate use when we buy them, right? So that's something small about the deferred settlement. Okay, so when the inventory is a qualifying asset, then we apply ICAG to calculate the interest that will capitalize or expense. Okay, but if the inventory can be used when purchased, immediately when purchased, it's available for use, then such interest cost will be what? Expensed, will be written to P&L and will not be added to the cost of what? Inventory, right? So that's the first part of IAS 2 inventory. There's more to look at. In the subsequent videos, we'll look at we'll solve some questions on inventory, on determination of cost. Then we'll also look at the subsequent measurement of inventory. That's at the lower of cost and then net realizable value. We'll look at cost formulas, cost techniques, and I will solve more questions. So if you like the video, please like, share, subscribe. See you in part 2 of IAS 2.